The real reason JPMorgan is being forced to deliver silver didn't begin last week, last month, or even last year. It began with a quiet shift in the global financial system that almost nobody noticed, a shift that turned a paper game into a physical obligation that cannot be escaped. And as of right now, that obligation has collided with a silver market breaking every assumption the big banks built their strategy on. What you're about to hear is not guesswork. It's not rumor. It's not internet speculation. It's a chain of mathematical certainties that pushed the largest bank in America into a trap that is now fully closing around them. To understand this trap, you need to understand what JPMorgan actually built. For more than a decade, they didn't just participate in the silver futures market, they architected it. They constructed a market where paper promises outnumbered physical ounces by margins that would be illegal in any other industry. But for years, it worked beautifully. Because as long as people took cash instead of metal, JPMorgan never had to worry about delivering anything. They could sell paper, hedge paper, shift paper, and settle paper, and the metal. That was just the story that kept confidence alive. Here's the catch. Markets built on confidence collapse the moment someone asks a simple question. Can I see the thing you promised? And in the world of silver, that question has suddenly become very popular. The reason is simple. Once silver crossed the $59 threshold, everything changed. Miners changed their selling habits. Industrial buyers changed their procurement behavior. International exchanges changed their pricing spreads. And all of those changes began draining silver from the very system JPMorgan depends on to honor the contracts they issued back when nobody asked for metal. The first sign of trouble came in the form of delivery requests. Not small ones. Not routine ones. Delivery notices so large that even JPMorgan, the bank that has dominated the COMEX vault system for more than 10 years, couldn't ignore them. They weren't facing just one unusually large demand. They were facing a pattern. Contract holders were no longer rolling their positions. They were no longer accepting cash. They were no longer settling quietly. They were asking for what was promised: real bars, real weight, real silver. And suddenly, the math that looked perfectly manageable for 15 years no longer works. Why? Because JPMorgan's silver strategy was built on one massive assumption: that fewer than 5% of contracts would ever demand metal. That assumption is now dead, and without it, everything else in their system collapses. To make sense of this, imagine a warehouse with 10 shelves, and only one of those shelves contains actual silver bars. The other 9 shelves contain paper saying those bars exist somewhere else. As long as nobody tries to withdraw from those 9 shelves, the operation runs fine. The illusion works. Confidence holds, and the system delivers just enough metal to keep everyone believing supply is abundant. Now imagine what happens when people start reaching for those other 9 shelves, and there's nothing there. That's where JPMorgan is right now. And the most dangerous part: this wasn't triggered by investors trying to squeeze the market. It wasn't triggered by speculators looking for a quick profit. It was triggered by the people who actually need silver: manufacturers, electronics producers, solar panel builders, and industrial firms that rely on silver for their products. These buyers are not gamblers. They cannot risk shortages. They cannot risk delays. And once silver crossed $59, they realized the market structure was flashing a warning light that said, secure supply now. So they're not waiting anymore. They're not hoping for lower prices. They're not trusting the COMEX paper system. They're demanding metal up front because their entire production depends on it. And that surge of real-world demand ripped the mask off the paper system JPMorgan has controlled for 15 years. Add to that the international factor, the widening price gap between Asian exchanges and Western exchanges. And suddenly, arbitrage traders began draining COMEX vaults simply because shipping silver overseas paid an instant profit. It wasn't political, it wasn't emotional, it was arithmetic. Buy at 59, sell at 62. Repeat until the vault's empty. And that's exactly what has been happening. Inventory falling, delivery demands rising, miners withholding supply, industrial buyers securing every ounce possible, and JPMorgan, for the first time since 2008, being forced to deliver more metal than they planned for. Here's the part almost nobody understands. JPMorgan can't simply refuse delivery. The silver futures market only works if the biggest players honor their contracts. If JPMorgan refuses, confidence collapses instantly. And when confidence collapses in a fractional system, the collapse isn't slow. It's sudden, violent, and irreversible. That's why they're delivering. Not because they want to. Not because they miscalculated slightly, but because the entire structure of their operation depends on keeping the illusion alive for as long as possible. But every ounce they deliver brings them closer to the mathematical edge. And once they reach that edge, there is no maneuver, no settlement, no regulatory loophole that can rescue them. And that's where the story really begins. To understand how dangerous this situation has become for JPMorgan, you need to look at what the regulators quietly changed while everyone was distracted by inflation, interest rates, and market volatility. Because the real trigger for this crisis wasn't a sudden surge in demand or a mistake in JPMorgan's strategy. It was a rule buried inside international banking reforms that very few people bothered to read, and even fewer understood. That rule came from Basel III. And Basel III didn't just tighten banking standards. It rewired the precious metals system from the inside out. For decades, banks treated paper metal the same as physical metal. If they held a contract saying they had silver somewhere, regulators allowed them to treat that as if it were real silver. That classification gave banks enormous flexibility. They could write contracts, expand positions, and leverage paper claims far beyond their physical holdings. But Basel III flipped that classification on its head. Under the updated rules, unallocated precious metals, meaning metal that is not specifically assigned to a customer and may not physically exist, are no longer considered high-quality assets. They became low-tier, low-value, high-risk positions. And here's where the trap snaps shut. If a bank has massive paper-silver positions, Basel III requires it to support those positions with an equivalent amount of real metal. That is exactly what JPMorgan has not been doing for over a decade. For 15 years, their strategy relied on selling claims to silver that didn't exist, because statistically, nobody would ever ask for the silver they paid for. But Basel III forces banks to back their promises with actual inventory. That alone would have been enough to stress JPMorgan's system. But that's not the only pressure they're facing. Another quiet shift has been happening on the industrial side of the market. For most of modern history, industrial silver buyers purchased their supply at predictable intervals, and they rarely competed with investors or banks. But the explosion of solar manufacturing, battery production, and advanced electronics changed the game. These companies now require massive amounts of silver, not for speculation, but because their entire business model depends on it. That's why when silver crossed $59, industrial buyers didn't hesitate. They panic. Their logic is brutally simple. Pay more now or shut down production later. For a technology manufacturer, a shutdown costs more than any metal shortage. A solar factory losing 1 month of output doesn't lose millions. It loses billions. So industrial buyers began sweeping up physical silver wherever they could find it. They went directly to miners. They outbid investors. They bought from refiners. And when that wasn't enough, they began pulling metal straight from the COMEX system. And once industrial buyers start withdrawing metal, there is no natural mechanism to replace it. Miners can't ramp up production instantly. Refiners can't increase output without new ore. Silver recycling takes months. That means every ounce leaving the COMEX vaults is gone. Not temporarily gone, but permanently removed from the exchange. And JPMorgan knows this. They see the same inventory reports the public sees, except they see them before the public sees them. They see eligible inventory shrinking. They see registered inventory falling even faster. They see delivery requests rising month after month. And for the first time in a decade, they are being forced into a position they hoped they would never face, delivering real metal. The delivery itself isn't the problem. JPMorgan can deliver several million ounces without causing a panic. The problem is what each delivery represents. Every time JPMorgan delivers physical silver, they shrink the cushion that protects their remaining contracts. And because their short position is massive, that cushion is already dangerously thin. If delivery requests accelerate, JPMorgan moves closer to a point where they will face a choice, with no good outcome, either default outright or drain their vaults to zero. But it gets worse, because JPMorgan isn't just dealing with industrial buyers. They're also dealing with arbitrage traders from Asia. When the Shanghai price rises above the COMEX price by even a few dollars, an arbitrage window opens. Traders can buy metal from COMEX, ship it to Asia, sell it at a higher price, and pocket the difference. Shipping, insurance, logistics, all of it becomes irrelevant when the spread is wide enough. And recently, that spread hasn't just been wide. It has been consistently wide. That consistency created a conveyor belt. Silver out of COMEX, silver across the ocean, silver into Asia, repeat. So now JPMorgan is facing pressure from three sides, at once industrial panic buying, international arbitrage, and Basel III physical backing requirements. Each pressure alone would strain the system. Together, they form a perfect storm. And the most dangerous part of this storm is not the outflow of silver. It's the psychology shift happening among contract holders. Because once people realize the system is vulnerable, they stop treating futures as a financial tool and start treating them as a claim on something scarce. And when something scarce becomes visibly scarce, demand doesn't rise slowly. It rises explosively. That's the stage JPMorgan is entering now. The stage where the illusion fades. The stage where paper promises meet physical limits. The stage where one wrong move sets off a chain reaction the entire market has feared for decades. And the next phase is the one JPMorgan cannot control. To understand what comes next, you need to look at the one thing that has held the silver market together for more than 4 decades: confidence. Not metal, not supply, not production. Confidence. The belief that no matter how imbalanced the system becomes, the big players, especially JPMorgan, will always find a way to deliver just enough silver to keep the illusion alive. But confidence is fragile, and right now, it's cracking. Not because of rumors, not because of panic, but because the math is becoming visible to everyone at the same time. Here is the core problem JPMorgan cannot solve. The silver market has reached a point where physical demand is rising faster than the system can hide it. The once massive gap between paper claims and physical inventory isn't theoretical anymore. It's measurable, it's documented, and it's shrinking every single month. And every contract holder who sees that gap shrinking begins asking the same question. What happens if I try to take delivery before everyone else does? This is how every bank run in history starts. Not with fear, but with logic. Because the people who request delivery now aren't paranoid. They're rational. And the moment rational behavior begins to strain a fractional system, the end becomes inevitable. This is why JPMorgan is trapped. Every action they take to reduce the pressure makes the pressure worse somewhere else. Deliver metal. They drain their own inventory and expose how little supply remains. Delay delivery. They signal weakness and encourage more people to request metal immediately. Roll contracts forward. They reveal that there isn't enough silver backing the old contracts. Shift inventory between vault categories. Traders see through it instantly because they've been watching these movements for years. In other words, every move JPMorgan makes today sends the same message. The vaults are not as deep as everyone was led to believe. And once that message spreads, the countdown accelerates. That's why deliveries are rising. That's why premiums are climbing. That's why traders who ignored silver for a decade suddenly want physical positions instead of paper exposure. And that's why the market is entering a phase that JPMorgan cannot manage, manipulate, or contain, the phase where the price is no longer determined by futures contracts, but by the actual availability of metal. When markets reach this point, history tells us only one thing happens: the price disconnects from the paper market entirely. You saw it with palladium when supply got tight. You saw it with nickel during the short squeeze. You saw it with European gas when inventories fell. Prices do not rise gradually. They snap. They gap. They jump in vertical steps because the system stops being a market and becomes an auction for survival. Silver is now approaching that threshold. JPMorgan knows this. Their filings make it obvious. In the past year, their paper positions shrank, their physical holdings increased, and their disclosures quietly warned that delivery obligations could exceed available supply during times of stress. In banking language, that is not a footnote. That is a confession. And the confession matters because of what it implies. JPMorgan is preparing for a scenario where delivery requests overwhelm the system. They're not reducing exposure because they want to. They're reducing exposure because they see what's coming before the public does. They see the industrial demand curves. They see the supply constraints. They see the arbitrage flows. They see the shrinking vault inventories. They see the regulatory pressure Basel III is placing on paper positions. And they see something the public is only beginning to notice. A physical market approaching a scarcity event. Here is the uncomfortable truth. JPMorgan can't stop what comes next. Even if they emptied every vault they control, even if they closed every short position, even if they rewrote every disclosure, the physical market is already tightening faster than any bank can respond. Because this is no longer about manipulation. This is no longer about trading strategy. This is no longer about controlling the COMEX structure. This is about supply and demand finally overwhelming the paper architecture built to suppress them. And when that architecture cracks, the price will not settle politely at some slow, reasonable level. It will seek the true equilibrium, the point where real industrial buyers, real investors, and real shortages collide. What does that look like? It looks like a market where 30 paper claims chase one physical ounce. It looks like a market where registered inventory approaches single-digit millions. It looks like a market where industrial buyers outbid everyone because their survival depends on it. It looks like a market where the old assumptions collapse in a single quarter. And when that moment comes, silver will not be priced by COMEX. Silver will be priced by scarcity. That is the scenario JPMorgan fears. That is the trap they built. That is the trap they cannot escape. Because once a fractional system is forced to operate as a fully backed system, it dies. And the silver market is now being forced into that transformation. So here is the final truth: silver at $59 is not the end of the story. It is the beginning of the revaluation. The moment the physical market reclaims control from the paper market. And once the world sees how little silver actually exists to satisfy the promises made for decades, the price will not just rise, it will reset. And that reset is already in motion.